Crude is the big talking point of the morning. Let's get in Matt Orton, Head of Advisory Solutions and Market Strategy, Chief Market Strategist at Raymond James Investment Management. We love having Matt. And Matt, to you, belated Diwali greetings, and from a Hindu calendar perspective, a new year as well. But thank you so much for talking to us today.
It's always great to join you, Raj. Thank you.
Yeah. So, Matt, we'll get on to the other global points as well. But I want to start off with crude because of what's happened. And there is a presumption or a news story which says that even China may reconsider Russian procurement of crude. Now, and at some point of time, and Donald Trump has said that India might do that, though we haven't heard confirmation from the Indian side. But presumably, all of those things have led, and plus the sanctions have led to crude prices move higher. Do you reckon that crude prices can stay elevated? And I use the term carefully because $65 these days looks elevated.
Yeah, it's a great question, and I think one a lot of investors are trying to figure out. And I think there's a lot of moving pieces to this, because not only have oil prices had a significant slide over the past couple of months, just as there's been increasing supply or surprisingly more supply coming on from a lot of the OPEC plus nations. On top of that, you've had questionable demand coming from certain countries. But now you have Russian sanctions, the economy being in a better place than maybe some people suspected. So there's a lot of interplay, and I think the heightened level of uncertainty with respect to what the path forward looks like, that is probably what's influencing the larger moves that we've seen very recently in crude prices. The sanctions, I think, are being used as a short-term tool by President Trump to affect change with respect to India, China putting pressure on Russia so that Putin can come to the negotiating table. And I think given the importance of getting geopolitical deals done, India and the U.S., China and President Trump and Xi have a summit coming up in South Korea. I think you're going to see the sanctions last at least a little bit longer, which means the uncertainty and volatility will last longer. But my long-term expectation is that crude prices likely stay lower, not higher.
Okay, Matt, point taken. I want to direct the attention now back to India and how you're viewing the capital markets here, because we've seen equity markets move higher over the past few sessions to a certain extent on account of covering of shorts by foreign institutions. That's taken place to a large extent, and we're significantly off the net short position that they started the series with. So the question is, do you see durable buying coming through though? Amidst everything that's happening globally, is India now, at this moment, more attractive than it was even a month or two back?
Yeah, well, to answer that last question first, Alex, yes, I do think India is more attractive today than it was a couple of months ago. And I think a lot of the covering of short positions is because you're seeing some earnings strength come back to the market. And we've talked a lot in the past that the key catalyst to really get foreign investors to focus on India is seeing a resurgence of expectations with respect to earnings growth going forward. And we're seeing that. Earnings results from the banks have been good. HDFC, ICICI, both very good results. Reliance had good results. And my expectation going forward is that having had the valuation compression earlier this year, India's underperformed a lot of the other EM complex. So it makes sense for investors to put new money to work in India and maybe cover short positioning on the expectation that a lot of the positive technical momentum, higher lows, higher highs, that's going to continue. And hopefully we start to see more money actually come into India long term.
Matt, does that happen, amongst other things, as a result of a dollar weakness, which has started off against some currencies? And therefore, is that a structural change as opposed to a cyclical change?
Yeah, I do think dollar weakness is a structural change, given just how dramatically trade policy has changed in the US. And I also think a bottoming with respect to, I'd say, economic growth expectations around the rest of the world and more diversification across foreign currency reserves. That's part of the reason you've seen gold start to surge. It doesn't mean the dollar's replaced as the the reserve currency of the world, but I think it just marginally adds that pressure there. I think, though, the key in this context is that the rupee has also been weak. And so I think what needs to happen, I think, to really get strength and momentum behind India for foreign investors is that the dollar weakness persists, but you see a stabilization of the rupee, especially with respect to the dollar. And that, I think, will also really help open up more long-term investments into India, along with better earnings growth and projections going forward.
One last specific question, Matt, and we often ask you this because you have a closer eye on the Indian markets than others do looking in. What specifically would you be buying? Because foreign institutions have traditionally gravitated towards banks, large banks, and IT. Do you have an opinion on these two? And which individual names are you looking at very closely?
Yeah, well, I like large banks. We've talked a lot about my favorite picks in the two names I mentioned before, ICICI, HDFC, both good results. I don't like IT. I think there's still weakness with respect to earnings. While we're seeing maybe some green shoots from some of the earnings reports we've had, it's nothing that makes me enthusiastic about the space. But what I have been enthusiastic about this year has been some of the consumer names, some of the automobile names. M&M continues to have a lot of strength across its auto premiumization trends. I like that. And I think the GST reforms are starting to translate and really support some of the more, I'll call them tech commerce names like a Paytm. Eternal has done well. I think the decline in prices may be a buying opportunity. And so I think there's a lot of places investors can find success in, call it the consumer discretionary part of the Indian market. And hopefully we'll get a read from management teams during this earnings season with respect to their expectations going into 2026 with the momentum they have behind them from the GST reforms and also what the festive season might bring too. So I'm optimistic on that part of the market going forward.
Last question, this has to do with asset allocation and what you're advising your clients. And you've already said that on the margin, you anticipate that because the dollar weakness is set to continue, gold has more wings. The question is, earlier in the week, a couple of sessions back, you saw it fall off a cliff. That seems to be just profit taking. But would you say that the durable trend is intact? Would you be advising your clients to buckle up and buy more gold if they possibly can whenever the opportunities arise?
Yeah, I think the key there is when the opportunity arises. If you haven't been exposed to gold, I would use downside opportunistically to establish small positions, but don't go all in at once. You need to dollar cost average your way in, given how strong the rally has been. My price target for this year was 4,000. My price target for next year is 5,500. There's going to be volatility along the way to get there. So pick your positions and don't chase upside, especially given the sharp moves higher we've already had.
Absolutely, Matt. $5,500 does not sound too crazy in the context of maybe a JP Morgan looking at $8,000 to the troy ounce by 2028. Thanks so much for joining us this morning. Pleasure speaking with you as always.
Thank you.